Hey folks, Dan Bird here for Technical Tuesday on Tuesday, September the 9th. And the topic I am going to cover is setting stops. I've had a few questions from a number of people about just exactly how do you do that. I talk about setting stops all the time. It's really important to protect your profits or to limit your losses. But some folks are a little confused about exactly how should you do that and what's the best way. Or you try to set them and you get stopped out right away, and then the stock takes off, which can happen. That's part of trading. That's just the way it goes. But we're going to talk about different ways, different strategies, techniques, different ideas about stops. And I will preface this by saying that it is a personal preference. So everybody can use different ways of setting stops. There's no one set way of doing it. I'm going to present a number of options, and you can choose the one that you feel most comfortable with or what works for you. But it's really a personal preference more than anything else. So, of course, I am not a financial advisor, so this is for educational purposes only. So let's jump into it and get started. First thing I want to do is talk about some ways of doing stops. So stop loss orders protect your profits and limit your losses. Basic order could be a percentage below your entry price, 5%, 10%, that type of thing. I also want to make sure you understand that setting stop loss orders can be automatic, or it can just be a mental exercise. In other words, if you set an automatic stop loss, which you can do in your platform, then that means that as soon as the price hits that particular order that you set up, it's going to execute no matter what happens next. If it keeps going down, then that's great. You got out without taking a big loss, but it could reverse and go right back up again. You don't have any control over that. Or you can set a stop loss order in your mind or a certain level and then wait till it closes at that particular level, not just that the price goes there. And I do it both ways. Really depends on what you're doing, what your goals are. But just keep in mind that there are a couple of ways to do that. So setting a percentage is great for beginners to enforce discipline, but it doesn't account for volatility. So if you've got a stock that trades 10% range every day and you set a stop loss at 5%, then you're likely going to get stopped out. You can set a dollar amount. So you define the maximum dollar loss you're willing to accept. So if you buy a stock for $100, you want to risk $10 and you set the stop at $90. You can also set a moving, well, we'll get to that in a minute. I think it's on the next slide. Yeah, you can set a trailing stop loss as well. So that $10 can be a trailing stop that just trails the price as it goes up and by $10 below it. So if it goes to 130, then if it drops to 120, then you're out. So you can either set it a hard stop at $10 below your price, or you can put a trailing stop that will trail it up. That's also true of the percentages. So you can set a trailing stop 5% as the price goes up. I'll show you this. I'll show some examples of this. You can also use support levels. I like to do this quite a bit. You can set a support level based on technical analysis of where the support and resistance are. Put your stop just below that key support. I will caution you that market makers, while they may not know where your particular stop is, they do know where most people like to set support levels based on technical analysis. So there are times when they will drop the price to just below that technical support level just to take the stops out, replenish their warehouse so they can start selling to the people that want to buy. So that can happen as well. Another good reason to set mental stops instead of hard stops. You can use a moving average, and I'm going to show you how I would do that, such as 50-day or 200-day. These are pretty wide stop levels, so I like the 21, as everyone probably knows. You can also use the ATR. I'm going to show you how to use this as well. So that takes into account the volatility of the stock. So you can, rather than just setting a certain percentage, you can determine what the normal volatility is and then set it 1.5 or 2 times the ATR below that level. Of course, trailing stops I talked about. You can also have a time-based stop. So if a stock just moves sideways and doesn't do anything for some period of time, let's say for 2 weeks, then you just sell it and get out. It's useful for short-term and event-driven trades. You always want to know what your risk-reward ratio is, so you aim for at least 1 to 2. So the ability to make $2 if you're investing 1. Avoid placing stops too close because they'll get stopped out very quickly. So you want to allow room for normal price fluctuations. If you can, backtest your strategy to see how it performs, and don't set stops based solely on emotion. Use data and logic. And that's a really important point right there. All right, let's get into it. Let's well, let me go back one. I'm going to put this slide on the website for subscribers. There's also a link right here that will take you to Investopedia, and will give you a lot more data, a lot more information about stops. What is a stop loss order? The advantages, way to lock in profits. Disadvantages is you could get stopped out, and your stock then just takes off without you. So in other words, setting a 5% stop, there's a history of fluctuating 10%. Why would you use them? What are the risks? Can a stop loss trigger a buy order? Yes, you can actually absolutely do that as well. How to determine the price level for a stop loss? Now that is really up to you. So it depends on a variety of factors, your risk tolerance, the volatility, and your investment goals. So this is a very personal component. Bottom line, it's a simple tool that can offer significant advantages when used effectively. So keep that in mind. If I go back to the website and go to the homepage, right on the homepage, and this is for anybody, you don't even have to be a subscriber. Right here, this little button here shows you all the different types of orders. So it shows you stop loss orders that are below the price. You can also have a stop buy order above the price. So that means if the price goes up, then you can put an order in to buy it at that price, or you can put a stop order below it, meaning if the price goes down, then you sell to get out. So you can use stop loss orders for either buying or selling. And then this explains limit orders too, which I'm not really going to get into today. So all of this is right on the website, right at your fingertips. I put this little chart together, so very easy to get to right on the homepage. All right, let's take a look at an example. I'm going to use the Qs. So basically the NASDAQ 100. So this is what it looks like right now, currently. It's up very, very slightly so far today. Here's the big sell-off, and here's the big reversal right here. So obviously you want to buy something when we're in an uptrend. So that's the very first step of your trading plan. The very first line of your trading plan should say, determine the direction of the market. So if the market's going up, then you want to be looking for things to buy. So this is what it looks like. Of course, you don't know when this first started going up, what it would look like. So what I'm going to do, and in fact, I'm going to point out here on the webinars and newsletters page for subscribers, these are all the past webinars that I've done, all the past newsletters down here. But there are also some training courses that I've done in the past. And one of them is Technical Analysis 101, how I use indicators and support and resistance. And this is a great primer for understanding how to set stops as well, using support and resistance or using levels. So I would encourage those that are subscribers, go take a look at that. So let's go back here. So first of all, I'm going to, and I do this technique on that webinar too. So I'm going to go in here and I am going to create a little box. Let's make it this color, and it's going to be solid. So I am going to, that's not what I want. I want a rectangle, solid. So I'm going to make it look like this. So now we don't know what the price is already done. Okay, so here's what we are. Let's say we were back here in February, market selling off right into April, and then we get a bottom right here. Looks like a bottom. Don't know that it's a bottom yet. April 7th. The next day it closes higher. Actually opens way higher, pulls back, but still closes higher. And then the next day is this big, huge white candle. So that right there, you could say, well, that I think is it. I think the bottom is in. There's other ways to determine this. I have things on the website. I have a bottom finder right on the website that works really well. And we'll look at this if the market ever sells off big time again. We'll look at these right here. The bottom finders are right here on the website. It will help you understand where the bottom is. But let's say we're here and we don't know if that's the bottom or not. So one thing that I always like to do, and I've said this many times, is put a 21-day moving average on my chart. So that's the first thing I'm going to do. Put a exponential 21-day, going to make it a solid blue line. And now we can see clearly that the price has been below the 21 ever since it started selling off right here after we went sideways. This is the market, how the markets usually work. I covered this earlier today in the midday update. So this is where the sell-off started right here at the end of February, went all the way down. We have not yet gone back above the 21. So most people, you should be watching to wait for a close above the 21 before getting in. So let's see what happens. Okay, let's take our little box right here and move it to the right. That's not a close, but it's looking pretty good. That's not a close either. Oh, look at that. Maybe we're heading back lower again. Lower still. Now it's going back up. There's one that went above the 21, but it did not close above the 21 until this day right here. So that is the day right there. Let's see what the date is. There's the first day it closed above the 21. That is April 24th. So that's the day that you want to get in. So now where do you set your stop? So using those different methods, you could set it either at 5%. So let's see what would happen if we tried to set a 5% stop. Right here, we have a percentage, and I'm going to just make this at about 5%. 4.99, close enough. And oops, don't want that one. Now we'll take this. You can see as it was going down, you know, if we had bought up here and set a 5% stop, we would have been stopped out at the bottom of that. And then as it goes down 5%, it could continue to get stopped out. Right here, it closed above the 21. So why not get in right there? There are some reasons, but I would say because number one, you're not confident that that downtrend is over yet. But I'll show you a way to be sure that you know that it's probably not done yet. But 5% down from there would have been right here. So you would have been stopped out just 3 days later. So where would 5% be on this one? That would be right down here, basically at the bottom of this gap. So let's say that's where we set our stop right there. So I'm going to leave that there for now. And then we'll look at moving this to the side again. The other ways that you can do it is you could set a stop at the low of, just below the low of the previous day's low. So you could set a stop right down here. Remember, we're just starting out, so we don't know yet if this is a good bottom. So we could have a stop right down here. You could also put it, there's the 5%. You also could put your stop at the bottom of the gap, but that's pretty much where the 5% one is. So let's say we put one at that low right there. Let's see how it works out. All right, now let's move sideways. See, okay, we're moving up, looks good. Still moving up. Everything looks great, still above the 21. All right, so now we came down and touched the 21 and then started to go higher. That's very bullish. The next day it gapped up, moved up quite a bit more. So what would happen now if I move my 5% line? Remember, let's say this 5% is a trailing stop. So the way trailing stops work is they will take the high of the day and they will have 5% from that level. And it will stay like that because this is a trailing stop. So this would move up there to that high, and that would be where the stop would be. So this is the next day right here. we move up to that high, and you can see the stop now at 5% is right where this one touched. And that's also where you could move your level stop at the same place. Put that right there. All right, so now we're looking pretty good. Remember, our purchase price was the top of this white candle. So we still would have a loss if we got stopped out at this point. All right, so let's see what happens if we move a little bit more. Now we're going sideways, one up. Oh, coming down now. Let's see, it hasn't come back to the 21 yet though. Oh, now we've got another gap up. So we got a big gap up right here. So now our 5% stop, remember, moves to the top of that day. 5% lower would be down here. Or you could set your level stop. You could set it at the low of the previous low. So they're pretty close to each other. The 5% would get you out with a little bit less of a loss, but both of these now are above our entry point. So we will not take a loss no matter what in this particular case. All right, let's continue to move it sideways and see what happens. As we go sideways, oh, the price is still moving up, going higher, higher. Now it's pulling back. So what we're looking for now is a higher low, especially for moving this particular stop. We're looking for a higher low. This one's going to move automatically. So it's always going to go to the high of where it was, and it will be 5% below that. Now, if we move sideways, but we're not going to move this one until we find a higher low. So let's move sideways. Now it looks like the price is moving up. That's moving up pretty nicely. So now we've got a higher low right here. So we'll move our level stop up to just below that higher low. And of course, our trailing stop will always move to the top of whatever the high was to 5% below it. Now they're pretty close to each other. All right, now let's move a little bit more to the right. Price is still going up, pulling back some, coming back near the 21. He touched the 21 right there and then started to move higher. So as it's moving higher at this point, we now can, of course, this one always moves to the highest point. So this is a 5% trailing stop. It will always move up with the highest price. And now our level stop would be at the low right here, this new higher low, right where it touched the 21. All right, this is also a place you can add as well whenever it pulls back to the 21. All right, let's keep moving sideways and see what's going to happen here. All right, we're still moving up, looking good, staying well above the 21. Don't see a real clear higher low at this point. Now that could be one right there. So now in this case, it actually went below the 21 and closed right at the 21. So if you were using a moving average and said, I'm going to set my stop just below the 21, you would have been stopped out in this case. So you would no longer be in the stock. If you were using a mental stop and said, I'm going to wait for it to close below the 21, you would still be in because it did not close below it, even though it went below it. But how does our trailing stop here look? So here's the high right there. The trailing stop, 5%, is well below it. So that's moving up nicely. Our level stop now, as long as this really is the low, so I want to see it moving higher from there. And sure enough, the next day it went back above the 21, pulled back slightly, and then back above the 21 again. So pretty confident that that is a level right there. So we can move the stop up to just below, and you can see it's also the low for this day. So now, again, we're pretty close to where the 5% moving stop is. Now we'll move this again sideways. You can see that the market continues to go higher, looking for a higher low for the level stop. But for our trailing stop, it's always going to go to the high of the day, so 5% below that. So that's where it would be. Continue to move sideways. Now we might have a higher low right there as well. And now we've come down again. So we came down, didn't quite get to this one. So that would be a good place to move it just below that particular level. It's also the resistance for these levels over here. Now, notice that the trailing stop has not moved because that's the high right there. So it will not move. It will stay right where it is. Whatever that previous high was, that one will stay right there. So now our level stop is a little above that. Let's continue to move sideways. This is live, by the way. And we don't have a high there yet. So there's today. So right now, as of today, remember we started way back here in April. As of today, our stops are set at these two levels right here. Both of them are pretty close to each other. So setting a 5% stop or just moving it up to the support levels, either way, you're pretty close. This one's at 558. This one's at 554. So within 4 points of each other. So that's how you could do it by setting, using the 5% level. Now, another thing that I always like to put on my charts is the 50-day simple moving average. And I usually make this red, of course. And if I do that, what we see now is this downtrend over here was when it went, even though it went above the 21, it was well below the 50-day right there. Now, this one here was also below the 50-day. So what was it that made us want to get in here? Well, number one, it's above the 21. Number two, it closed at the end of the day, closed at the high of the day, which this one did as well, just didn't move as much that day. You could wait for the next day just for confirmation. In this particular case, it would have dropped back below. In this case, it didn't. So you could have waited one more day, but the stops would have been moved up in the same way, just like that. So that's how we can tell whether it really might be in a reversal uptrend, starting back into an uptrend. The other thing that we can use is, in addition to the 21 EMA, is we can use the chandelier exits. And I covered these in a previous Technical Tuesday as well. So you can go back and check those out. I like to make this a dashed thin line, green one. I talked about how these are calculated, but you can see that this kind of is in between the 21 and the 50. So in this case, if it closes below the, actually this one did close below the 21. I was wrong when I said that before. It opened at the 21, closed below it. But in this case, it also closed below the chandelier. So if you're using both of those, you might have been out right there, but then right back in the very next day when it went back above the 21. So that would have been a whipsaw, which can happen, absolutely can happen. So the other thing is, why do we use 5%? Why is 5% magical? And it's not. You could use 7% if you want to follow IBD. They say if a stock drops more than 7%, you should be out. So you can use a 7% trailing stop. The other thing you can do is use the ATR, the average true range, which gives you a sense for volatility of this particular stock. In this case, we put it in down here below the price. So what we can now see is we'll go over here and take a look at this particular bar once again, and we'll look at what the ATR was on that day. So the ATR was $17 for this particular close. So the close right here was 466. So it was $17 below that. So 17 divided by 466 is 3.6%, or about 4%. So that tells me that I could use a 4% trailing stop and probably be pretty safe based on the ATR. And you'll notice the ATR is dropping. It's getting lower as the price goes up, mostly because the distance between the open and the close is much lower. When stocks go down, the distance is much greater because they go down much faster than they go up. So the average true range increases. You can see it down here as a stock falls. But when it's going up, which is the time you want to be in and you want to determine how to set your stops, this is a way you can do it. Using the average true range, in this case 5%, is probably a good one for your trailing stop. So use the average true range to figure that out. That's a good way to figure it out. So that's a way to use levels, a way to use moving averages, the chandelier exit, which I've covered in the past already, is another way. You can use it as a secondary or a confirmation before actually exiting. If something goes below the 50, like it did right here, another good example. Another good example of a mental stop instead of a hard stop. In this particular case up here, the hard stop would have taken it out if you're using the level, but the 5% probably wouldn't have. So it dropped down right there and then started to move up. So remember, this is going to stay right here because that was the high. So it's not going to move until we get a new high. So that's the way you can do it there as well. So there's a few different ways to set stops. The ATR gives you a sense for what the volatility is. Let's look at a different stock. Let me see if I can pick one that's more volatile. Let's see, SMCI. So SMCI now, let's say this one right here. This one it closed at 38.89, and this was about $3. So 3 divided by 39, let's call it. So that's about 7.5, almost 8%. That's almost an 8%. So for a stock like this, you probably want to set your trailing stop at 8 to 10%, just to make sure you don't get stopped out. So that's the way to figure that out. Use the ATR down here. Gives you a sense for how much this moves typically in a normal day. So that's a good way to do it as well. Hopefully this was useful. Here's just looking at the other thing to notice and understand about when a stock is in an uptrend is you want all the moving averages to be stacked positive. So you want the 5 to be above the 13, to be above the 21, to be above the 50, and then of course everything above the 200. So as these are starting to become stacked like that, right here is where the 5 moved above the 21. So that's step 1. 13 moved above the 21. The 5 moved above the 13 way down here, and then above the 21 here, and then 13 above the 21 there, and then the 21 moved above the 50 right here. So right in this area, you have all but the 200 that are stacked positive. As opposed to over here when we're moving down, especially right here, where it came back just above the 21, but you'll notice it hit the 200. So that's another key level right there. But more importantly, the moving averages are stacked negative. So the 5 is below the 13, 13 is below the 21, 21 is below the 50. So they're all, and the 50 is not quite below the 200 yet, but all of the other key moving averages are stacked negative in this case. And that's why you would not have gotten in on that one. You would wait for this one right here when the moving averages are just beginning to be stacked positive. So that's another way to figure that out and determine what it looks like. Right now, everything is very bullish. The market is not moving very much. It can't get back above this high up here. So we'll see what happens. But hopefully that helps to understand how to set your stops. You can either do it mentally, you can do it with a hard stop in your platform. Allows you to set either percentage trailing stops or a percentage stop, or you can do a dollar amount trailing stop as well. Either way. So hopefully that was helpful. Let me know if there's any questions or anything else you would like to understand about how to set stops. I will be putting this spreadsheet that I showed you, I'll put it on the website, and it will give you a link to some of the other content. So it'll be out there anytime you want to see it. All right, I hope that was helpful. Thanks for watching, and we'll talk to you again tomorrow. Take care.